Welcome back to Happy Half Hour. That's Toby Weber. I'm Nik Schuurmans. This is the Waverly Advisors edition, our first episode under the new umbrella. Our sign is gone. I can't wear, I'd say 90% of my clothes because it's pure portfolios, but I did get a Waverly Advisor
Oh, look at that.
sweater. So this is the new logo, and I actually do like the logo.
Yeah, nice.
Except most people, if I can say this, don't really know what this is, so it'd be nice if they had
Waverly on the
Waverly on the
sleeve or
side, but
something.
I digress.
Looks good. Yeah, nice.
Okay, so what's on your mind today, Toby? There's a lot. I've got a few topics, more throwing stuff out into the ether, and I want to hear your response. A lot going on in markets. I think this is a really good time to have this conversation, and I run the risk of repeating myself, but we're seeing a lot of the same themes emerge as far as investor behavior and positioning, and I just think it's a great time to look at the risk management side while most people obsess about, hey, I'm up 5%, I'm up 10%, I wish I was up more. It's like those are the wrong types of comments in this environment.
Yep. Feel free to take the lead and throw out a question, and we'll jump off from there.
Okay, this might be...
Entrapment?
It could be entrapment, but what do you make of some of the CapEx numbers that are coming out, capital expenditures? So a lot of these big tech companies have just reported, and a lot of them are posting blowout earnings, and then they disclose their CapEx numbers, meaning what they're spending on infrastructure, data centers, all this stuff around AI, and a lot of these names are just getting punished. What do you make of that?
Well, I think everybody's got an eye towards the AI narrative, which has kind of carried the market. And I think they're thinking at some point we probably reach exhaustion. And maybe it's a CapEx, how do we pay for all this stuff? What's the return on all this investment? Maybe that's what you're starting to see in some of those reports. Oracle's, you see where their CDS
Credit default swap.
credit default swaps rates have blown out, which is an indication of concern about their ability to fund their business and fund all this CapEx. These are companies that generate a ton of cash, so they have a ton of cash, but even the ones like Apple and Meta are having to borrow money or choosing to borrow money. So I think it's maybe people are finally saying, hey, maybe we need to see the return, and maybe this spending can't go all the way, these trees can't go all the way to the sky.
Yeah, and credit spreads are something that we watch, and what Toby's alluding to, when these credit default swaps blow out, meaning they go up in value, investors are betting that the credit profile, the credit worthiness of the underlying entity might be in doubt, okay? When credit spreads are tight, that means there's really no worries from a credit standpoint. So credit default swaps are something that savvy investors watch, and it's something that's very much a part of our rules-based process. Kind of zooming out, unrelated to AI, but when you look at history, if you go back 80 years, the CapEx factor actually is highly correlated to lower future stock returns. So companies that shovel money into capital expenditures often see lower future returns. I'm not saying that's going to be the case for AI, but you go back to telecom in the 90s as a perfect example. These capital intensive businesses are basically mortgaging the farm that all of this is going to work out. And the AI narrative can go any which way. No one really knows how it ends. Certainly a lot of these companies are investing now and asking questions later, and at some point, as Toby alluded to, the bill's going to come due and people want to see return on their invested capital. On that same note, when you zoom out and look at what the NASDAQ has done this year, which is a very tech-heavy index, I think the market is trying to tell you something. And the NASDAQ is essentially flat. And there's a rotation going on in markets where you could basically look at any equity asset classes, and this is something that we've been talking about for a while, small cap, value, equal weight, emerging markets, real estate even, foreign stocks, pretty much everything under the sun has performed better than US large cap. But when you go on Twitter, for example, it's like just buy the S&P and chill. And it's like that that narrative really bugs me because I think it sets folks up for failure or at least disappointment.
So far in 26, are you seeing some of the same themes that we saw towards the second half of 2025, or does it look to be a little different coming out of the gate in 26?
It's starting eerily similar to 2025. Of course, we got the disruption with the trade tariff stuff back in the spring, but as far as the leadership goes, it's emerging markets, it's foreign stocks. Gold's had a really good start. Gold's starting to act a little squirrely too, which is not unusual if you've been following the asset class for a while. But it's nice to see the rotation. What we've been talking about for 18 months is the investment universe extends beyond the S&P 500. It extends beyond the NASDAQ. So I think, again, and if you go back to these episodes, I often repeat myself, this is a really good time to check your position sizing. We've said we want to own the robots. We want to own AI. It's littered within our models. However, you want to be very mindful of your position sizing, and that's the story the market's trying to tell you.
Mm-hmm. What do you make of gold and Bitcoin? They've kind of been diverging a bit in the past 6 months or so. Maybe give an update on what you're thinking of Bitcoin, which has come off quite a bit. And then, as you said, gold has been an interesting ride just in the past 6 weeks.
I'm a little cautious on the sentiment side of gold. My barber asked me if it's too late to buy gold.
Oh boy.
And I'm always making a mental note of all these sentiment tops.
Barber sentiment.
And when people people that usually wouldn't ask about an asset class, when they start asking about it, that's when a red flag goes up for me. So gold is, it checks a lot of boxes. I've written a lot about gold, how as governments around the world are reckless with their spending, people want to own a store of value, a sound money currency. In gold, you have to take it out of the earth, but it's really hard to just create more supply out of thin air. So I think gold still checks a lot of boxes, but you want to understand why you own gold. Know that as the price goes up, that's going to attract more investment dollars, more investor attention. Some of this stuff is quantitative trading, short squeezing, leverage being flushed out. All of these things play into a volatile commodity. As for Bitcoin, it's acted a bit squirrely. We got the run up the early part of last year as the ETF kind of gained some institutional adoption. It was easier for an investor to buy Bitcoin. I think the shine has kind of wore off a little bit, but a 20% move in Bitcoin is really nothing. And from where we introduced the ETF back in 2024, most of our client positions are still up. And what I like about Bitcoin is it often acts differently than some of these mainstream assets like the S&P 500. So again, Bitcoin, I still think has a place. Be mindful of your position sizing. One phenomenon that I saw last spring, a lot of folks were asking, a lot of our clients were asking, hey, I should own more in Bitcoin. Let's add to Bitcoin. And I pushed back and said, hey, Bitcoin is going to give you an opportunity. It's probably not at 125,000. So being patient with Bitcoin, if you want to add to your position, know that it is prone to some wicked drawdowns, which often allows for a better entry point.
Yeah, it's interesting. Those two asset classes are great examples of when everybody's rushing in, when they're on the news, when sentiment is really hot. That's probably not the time to be adding to those positions in gold and Bitcoin. And conversely, when nobody wants it, it's kind of on its ear and down quite a bit, that's probably the time it's not a terrible idea to add a little bit to it. But human nature has us going the opposite way. Hey, gold is hot, let me go buy gold and silver. Bitcoin, nobody wants Bitcoin, I don't want to buy that. But perhaps the opposite timing would be true. Gold has been interesting in that it's pretty much doubled since the latter part of 2024. So 2025, it was up about 65-70%. And at one point it touched $5,500 an ounce in early January, which was roughly a double from 13 months earlier. It's since backed off $1,000. It wasn't that long ago, gold was $1,000, and over the course of a week or so, it dropped $1,000. So to Nick's point, gold is is acting a little squirrely. It's probably gotten well ahead of itself. It's definitely due for a breather. Doesn't mean it couldn't go higher this year, next year, but chasing it here probably isn't the best idea.
Well, in most of these commodity type assets, when they have a parabolic rise, usually the drop is just as fast. And we saw that a couple weeks ago. So what we've done at Pure, we've been over allocated to gold for years now. During our rebalances, we actually sell gold and bring it back to its target weight. So again, I think it's prudent if you do have a position in any asset class that goes way up and it's becoming a bigger part of your asset allocation, it's a good time right now to rebalance and bring those back to target weights.
Okay. I've got a couple other questions, but you got something on your list there?
I mean, I have a comment that, and I'm going to write about this next week, but I'm starting to read more about, the early leaders in AI, and folks are drawing parallels to the early leaders to the internet boom. And if you think back to the internet boom, the early leaders were Sun, were Netscape, were AOL, and they either went bankrupt or they were bought at a much lower value on the front end of these emerging trends. And I'm starting to see whispers and hear whispers of kind of the same thing. You have these early leaders that are investing billions year over year in AI models in the infrastructure. That doesn't necessarily accrete to being the end game winner. So I think what really excites me is that AI does work. It's a really good technology. We use it across our business, from investment research to dissecting documents for content ideas. But I think the end benefit flows to the other, call it 495 companies in the S&P, not necessarily the early leaders and the names on the front page of the news. So that's more my opinion. It's more something that we're watching, and it's part of the reason why we've been diversifying and shaking up our U.S. large cap exposure. So we recently introduced an equal weight index to large cap. And basically what that means is, instead of owning the S&P 500, where if you invest $100, 40 or 45 of those dollars are going into a handful of companies, right? The 7 companies that explain a good chunk of the S&P's performance. The S&P 500, the market cap weighted version, is essentially a momentum tech index because so many of your dollars are going to those top companies. An equal weight index, you invest $100, 100 of those dollars go equally across all 500 companies in the S&P 500. It's a way to smooth out the concentration risk. We've also been trimming our individual tech names, which we own across various stock models too. So again, creating intention around your US large cap exposure. By any historical metric, US large caps are stretched. We want to own them. We just want to manage our position sizing.
Yeah, and I think another way to get there is putting a little more emphasis on value, as you've talked about in some of your comments and blog posts. And value tends to be the names that aren't the high flyers, aren't the tech companies, the growth companies. And so getting exposure to other corners of the large cap US market is what we're trying to do, either through a value index of some sort or through an equal weight fund as well. So just trying to bring some balance to the portfolio. Obviously we don't know where the future, where things will head in the future, but just trying to make sure that we're intentional, as Nik said, and we're balanced across the portfolio.
Yeah, and a lot of investors think you take a bunch of risk, you load up on what's worked, the market sells off by 25%, and now you look to make some changes. It's, I said this in my last week's post, you need an umbrella before it rains. So the time to prepare for the next crisis, whatever it is now, is dialing in your position sizing, making sure your portfolio reflects the way you feel about risk, not making these emotional decisions based on the latest narrative out there.
Good. Okay, I got one for you.
Okay.
Give an update, early days with Waverly, but maybe talk a little bit about what we're finding with Waverly and how that's going. Again, we're only a couple of weeks into the partnership, but maybe talk about early impressions and how things are going.
It's been really good. It's been better than I expected. Last week we had our tech mapping over, so all of our legacy systems plugged into Waverly, That's not my favorite thing. I don't think that's a secret. But now we're actually getting to the work, and we're reaching out to clients. And I think most clients, I've received a few notes like, hey, the website looks great. I'm able to get on my client portal. So like we said before the deal commenced, nothing really would change. I mean, we're waiting for some signage and some small stuff, but the same responsiveness, the same access to tools. We're going to be hiring someone who starts next week. She's a CFP and also a CPA, so tax expertise in-house. But back to your question, the Waverly folks have been very accommodating. They've actually have impressed me in that we have access to experts that we didn't have before. And I'll give you an example. We had a prospect find our website through Google, which is not uncommon for us. This woman had an options portfolio. Well, we don't really delve in options. We don't trade options. On rare cases, we might use an option to hedge. But she had an options-only portfolio that she was looking for an advisor to manage. I reached out to our senior director of portfolio management. He hopped on the phone. It was right in his wheelhouse. It was like, wow, this is a prospect we would have passed on. Now she might become a client. We might be able to help her, and she might do it herself. But the story is we have additional resources and capabilities that we did not have before, overlaid with what we've already done well and all the services in which we offer. So it's been a really good partnership. I'm really excited to see what the future holds, and we're just scratching the surface on what we can leverage from the Waverly side.
Yeah, I would echo some of those same things. The people at Waverly have been great as advertised, but just really accommodating, really helpful. And to Nik's point, there's a lot of depth of expertise and depth of resource within Waverly that we're just scratching the surface in terms of how to tap into that and how to help our clients with that. So we're very excited about that. And again, early days, and there will surely be some bumps as we move forward, but we feel like we've got a great partner to help us moving forward. So I've got one more question. You got another one? Or?
I've got nothing. I'm going to shut it down.
Okay. Super Bowl. Do you enjoy the Super Bowl? Do you watch it with the family? Do you completely ignore it? What's your Super Bowl routine, and how did it go this year?
Well, from a social standpoint, I don't think you can completely ignore it, but I did not have a dog in the fight. I'm not really an NFL person. I play fantasy football with my buddies, but that's about it. I'm actually a bit displaced. I'm in a rental house right now because my house is being remodeled. So it was a bit odd. The family kind of watched the game. They came and went. I have 3 kids under 12. They can't sit still for more than 10 minutes. So it wasn't really a family affair. We didn't have people over. We had basketball all weekend, so we were just looking to chill. So my wife and I just kind of watched it because a lot of our family do like the Seahawks. And it was to be honest, it was kind of a boring game.
It was a boring game.
It was kind of ugly. The first half was brutal. But, it's cool to see the spectacle, the halftime show, and all the stuff that comes with it, the commercials.
Yeah, I was happy that Seattle won. For all the people that are big fans, I like Seattle, but it's not my team or anything. But I thought it was neat to see that. I've noticed a trend in the last couple of years with the Super Bowl. It used to be, hey, get everybody together, big Super Bowl party, blow it out. This is going to be great. And more, I think what people want to do is stay home and watch the game so they can actually focus on the game and the commercials and all that. So we had some people over, but we had them over before the game, and then everybody scattered and went home and got to watch the game at their own place. So I just have noticed that trend lately. The big Super Bowl party may be a thing of the past.
Well, if your team is in it, if your team is playing in any massive game, I don't want to talk to a stranger that I have no clue. I want to lock in. If the Washington State Cougars ever play for a national title, or the Blazers ever play for an NBA title, I'm going to be locked in a room alone, screaming at the TV.
Sure.
Completely locked in like I'm playing.
As any self-respecting fan would do. So I did one more nugget for you on the Super Bowl. Next year, the Super Bowl is on Valentine's Day, and the day after is President's Day holiday. So the people that clamor for, hey, we ought to get a day off after the Super Bowl, next year is your year, although it is on Valentine's Day, so you'll have to balance those two events.
And there is a market quirk, right? Like you see these market analysts that say, oh, if the NFC team wins, the market does this. when the NFC team wins, the market for the rest of the year does like something like 12% on average versus the AFC, which is 7% on average. Not saying that's more for fun. Obviously, we're not making investment decisions based on that, but people look for any data point to support their thesis or to have a hot take, if you will. Great, so that's it. The first Happy Half Hour Waverly edition. I hope you enjoyed this. Follow our blog, follow our podcast, follow our YouTube. If you have any questions, shoot us a note. Nik.Schuurmans@waverlyadvisors.com. We have a generic inbox, but I don't know what the address is.
Yep.
So maybe we'll pin that in the comments.
Yep.
Thanks for watching. We'll see you
Cheers.
next month.